Pfizer reports its second quarter earnings tomorrow morning before the market opens. And the question for income investors is simple. Is this high-yielding healthcare giant a generational value play or a classic dividend trap? Trading near $25, Pfizer sits right near its multi-year lows, yet it packs a monster forward dividend yield near 7%. With COVID vaccine revenue continuing to reset to baseline levels, Wall Street is watching closely to see if non-COVID commercial growth can stabilize the bottom line. For passive income investors, this quarterly report isn't just about headline numbers. It's about whether Pfizer's cash flow can comfortably protect one of the most famous dividends in the entire stock market. Wall Street expects Pfizer to deliver second quarter revenue of roughly $14.4 billion, representing about 6% year-over-year growth compared to the $13.5 billion posted in Q2 of last year. Adjusted earnings per share are projected at 68 cents. For the full year 2026, management has reaffirmed guidance for revenue between $59.5 and $62.5 billion, with adjusted EPS coming in between $2.80 and $3. The real story behind these numbers isn't COVID anymore. It's how fast non-COVID revenue is expanding to replace legacy vaccine declines. Beyond the headline figures, investors are watching three critical catalysts tomorrow. First is the performance of Pfizer's core oncology and rare disease portfolio, including key drivers like Padcev, Vyndaqel, Eliquis, and Nurtec. Second is progress on Pfizer's multi-billion-dollar cost realization program, which aims to carve out significant operating expenses to expand gross margins back toward the mid-70% range. And third is Pfizer's early-stage pipeline in the obesity space following its Metsera asset deals. Any unexpected update on clinical trial readouts or commercial uptake in these segments will drive the stock's immediate reaction. The bull case for Pfizer revolves around valuation, cash flow, and a massive margin of safety. At $25, Pfizer trades at under 9 times forward earnings, a deep discount to the broader healthcare sector. Bulls point to Pfizer's rock-solid dividend history, having paid over 350 consecutive quarterly dividends, with an annual payout of $1.72 per share, fully covered by full-year earnings guidance. BMO Capital maintains an outperform rating with a $30 price target, while average Wall Street consensus sits near $28.75. Bulls argue you are getting paid a 7% yield while waiting for the pipeline to re-rate the stock back to $30 or higher. Bears, on the other hand, view Pfizer as a value trap, weighed down by impending drug patent cliffs and heavy debt following major acquisitions like Seagen. Several core blockbusters face loss of exclusivity later this decade, which could wipe out billions in high-margin revenue. Furthermore, COVID product demand remains volatile, and execution risk on new drug launches is high in a competitive pharmaceutical landscape. Bearish analyst price targets stretch down to $24, arguing that without a massive blockbuster breakthrough in oncology or obesity, revenue growth will remain muted and capital appreciation will stay stagnant. Here's how I'm personally managing my own position in Pfizer. Look at my actual portfolio numbers. My capital gain is down about $88, but because Pfizer has consistently paid out $96 in dividends, my total return is actually positive at plus 3%. That is the power of a high-yield dividend strategy in action. Cash flow cushions your downside while you wait for a recovery. Heading into tomorrow's report, depending on how the earnings and forward guidance look, I will probably add more to the position. If earnings beat expectations and show solid non-COVID growth, I'll gladly stack more shares to lock in that 7% yield. If there's an overreaction drop, I'll look to write cash-secured puts or pick up discounted shares to lower my cost basis even further. This is my personal trading plan, not financial advice. That's the setup heading into Pfizer's Q2 earnings report tomorrow morning. Are you holding Pfizer for the 7% dividend, or do you think it's a value trap? Drop your thoughts in the comments below. and subscribe for my full post-earnings breakdown. This is for informational and entertainment purposes only. Always consult a licensed financial advisor before investing. See you in the next video.